Well, hi folks, it's Stratman here from pipware.com. The last video was an introduction to trading strategies, and we kind of introduced the idea that most trading strategies are built with three main components. The first being just price action itself, whether we're looking at 1, 2, 3 patterns or reversals, reversal candle formations, so on and so on. So those pure price action, support and resistance, so on and so on. The next part we quite often would use would be the moving averages. That's our second component, and then the third component is using some form of oscillator like RSI, stochastics, so on, to filter the trading opportunity that we can see up on our moving average versus price action. Today we're going to concentrate more on the price action part and just look at a few candle patterns to understand how that works. I do a lot of reading on the internet. I particularly like reading heaps of stuff in Forex Factory, but I wanted to show you today that look, even ideas that have been used for not just Forex can be applied to so what I'm saying is the share market, stocks and so on. We can sometimes take those ideas and use them in our Forex market, and they prove quite successful. So here's something that's quite old, so it doesn't need to be recent, and it was used for E-mini NASDAQ futures. So let's have a look at some of these patterns. Now, before people used candlesticks, they used to use price bars. So if we have a look at a typical situation and we look at what we call a continuation system or pattern, you can see here that the price bars, so the left hand side is the open, the right hand side is the close, and it's red because it's the close was below the open here. So if this was a candle, that would be a body between this point and this point, and then there'd be wicks either side. So it doesn't really matter for this discussion, but as we're looking at this is a typical retracement bar pattern that we can trade off if we consider that there's going to be a continuation of the trend. This is a very common technique I use when price is going one way. If we see a retracement, notice how when I hover over this it flips, so I can see the kind of same idea but in a downtrend, take it off, and I set an uptrend. Let's look at it in a downtrend at the moment. As price is coming down, we see a retracement, and what we can do is we can put a sell order just below this candle after it closes, and then if it continues to make higher lows here on this candle, we can continuously keep moving our sell order up. So this is a good way of just using price action. It helps us get a better price, because if we put a sell order just here, potentially we haven't got the best price we could get. So that's what this is showing us. Come down, put a sell order there below that retracement. If it retraced a little bit more, we can put another sell order there, another sell order there, right until the point where it finally busts through and takes off. Kind of like what they're showing here. And on the opposite direction, we can do the same thing. So this is what we call retracement bars. Well, this is what this guy is calling a retracement bar. Let's look at a couple more patterns that we could use. So that was a continuation signal. We've seen the retracement bar. Now this is a 1, 2, 3 top or bottom. The usual way that a 1, 2, 3 is explained is a little bit differently than this, but this is as described by some guy who's doing Wall Street Master. Anyway, so their idea of a 1, 2, 3 pattern is you've got a trend line coming down, you've broken the trend line, so that's your number 1 point. It comes up to a point and turns, and then comes back, but it fails to make a low below the previous low. So that means that we've got kind of like a higher low. So if we've got a higher low, potentially we might get a higher high than the previous high. What does that mean? That means trend reversal pattern, means we're now going long. So one aggressive entry for this kind of pattern is that if as prices come down, breaks through the trend line, comes up, does a retracement, fails to get to the low here, we start, like the previous pattern we looked at, start placing buy orders. So we could have put a buy order there, buy order here. If we got another candle here, we could put another buy order here. In fact, this is very similar to a system that I've seen Joe Ross discuss in a video. And some people would probably enter quite often on these patterns on a break of this point. And typically this would be called the 1, this would be called the 2, this would be called the 3, and a lot of people would have a buy order right here, ready to enter at this point. Interesting thing is that if you do that, you may have missed quite a bit of the move. And you've got to remember the big boys, they know these patterns quite well and know that there'll probably be a lot of orders here with stop orders probably down here somewhere. So the best time to get in is probably to buy here and get out up here. I did see a Joe Ross video that kind of explained a similar idea. So it's not my idea, someone else's idea. We're just looking at possible patterns that we can use for our own trading. Let's carry on. What's another type of pattern? Well, we've got an inside bar. So inside bars could be quite useful because inside bars quite often price will break from those. So when we say an inside bar, what we're meaning is that, well, there's a description of what an inside bar is here, but essentially it means that the high and low of the current bar is encapsulated by the high and low of the previous bar, which usually means that the market's kind of in a congested or waiting kind of ranging state, and we're waiting for it to break out of that, but based on basically just single candles. So usually you would put, if you thought that this was a reversal pattern, you would put your sell order pending right here, ready to capture on the next bar. Same as down here, same thing, it's come down, someone's decided to put a buy order there, and away we go. So inside bars are quite good, so that's another price action idea you can use for your trading. Before you hop off there, I'll let you see the alternative scenario based on the graph being flipped up the other way. So again, this guy was using this for S&P 500 futures on 5-minute bars, but hey, it's all applicable to Forex. I find this kind of stuff works really well in Forex. What are some of the other ideas? Well, the traditional swing highs and swing lows. Well, for us, we consider those to be called fractals pretty much now. So that's your high fractal, low fractal. So usually we're looking at a trend is when we're making higher lows and higher highs, higher low. Now this was a lower high. If it had made a lower low down here, we would consider that to be really a break of this uptrend and now downtrend. So another more useful pattern. So I quite often use fractals on my charts based on this kind of concept as well. Quite like the idea of trend being trend up is higher highs along with higher lows, and a trend down, if we look, well, I haven't got a trend down at the moment, but a trend down would be lower lows and lower highs, obviously lower high there, and if that was a lower low, then that's a downtrend. So you could combine all those kind of ideas together and create a very nice little price action strategy. So that is just one component of a typical strategy, candle patterns, very important. Next lesson we'll do, or next video on strategies we'll do, is I think we might take a look at moving averages. Okay, we'll see you on the next video.